Here's the question. An auditor can lower overall audit risk by Choice A says inherent risk, Choice B says control risk, Choice C, detection risk, and Choice D says all of the above. Now, let's define the key terms first. Inherent risk means the chance that a financial statement account or transaction is misstated before considering any controls. It's tied to the nature of the item. Cash has high inherent risk because it's easy to steal. Complex derivatives have high inherent risk because they're hard to value. As the auditor, I can't change the business, so I can't change inherent risk. Control risk means the chance that the client's internal controls will fail to catch or prevent a misstatement. Weak segregation of duties, that's high control risk. Strong automated controls, lower control risk. But again, those are management systems. I don't design or run them, so I can't change control risk either. Detection risk means the chance that my audit procedures will fail to detect a misstatement that exists. This is the part that lives in my hands. If I do sloppy work, detection risk is high. If I design stronger procedures, gather more evidence, or increase sample sizes, detection risk drops. And finally, audit risk is the risk that I, as the auditor, will issue the wrong opinion when the financial statements are materially misstated. The model is audit risk equals inherent risk times control risk times detection risk. Now, let's apply all that to the choices. Choice A, inherent risk. Can I lower it? No, the client's environment determines it. If they're a high fraud industry, that risk is baked in. Choice B, control risk. Can I lower it? No, that's management's responsibility, not mine. I only evaluate it. Choice C, detection risk. Can I lower it? Yes, this is my knob to turn. By changing the nature, timing, and extent of my audit procedures, I directly affect detection risk. So the correct answer is choice C, detection risk. Exam trap warning. All of the above is bait. It looks tempting, but remember, inherent and control risk sit with the client. The only lever the auditor controls is detection risk. And here's your memory hook. Picture audit risk like making soup. Inherent risk is the raw ingredients. Sometimes they're already sketchy, like wilted spinach. Control risk is the kitchen setup. Maybe the stove is broken or the chef forgets to stir. I can't fix either of those. But detection risk? That's me, the auditor, actually tasting the soup. If I take more careful sips, I'll catch bad flavors. If I never taste it, the risk skyrockets. Final answer, C, detection risk. Here's the question. On the basis of audit evidence gathered and evaluated, an auditor decides to increase the assessed level of control risk and therefore the risk of material misstatement from that originally planned. To achieve an overall audit risk level that is substantially the same as the planned audit risk level, the auditor would. Choice A says decrease detection risk. Choice B says decrease substantive testing. Choice C says increase inherent risk. Choice D says increase materiality levels. Now, let's unpack this step by step. First, some quick definitions so the model is fresh. Inherent risk is the natural risk of misstatement before considering controls. It's tied to the nature of accounts or transactions. Control risk is the chance that the client's internal controls won't catch a misstatement. Detection risk is the chance my audit procedures fail to detect a misstatement that exists. Audit risk equals inherent risk times control risk times detection risk. Risk of material misstatement, RMM, equals IR times CR. Now, in this question, I've already decided to increase control risk based on the evidence I gathered. And since RMM equals IR times CR, if CR goes up, then RMM goes up too. But my planned audit risk, the overall level, is supposed to stay the same. That means I need to compensate somewhere else in the model. The only lever I control is detection risk. If RMM is higher, then detection risk has to come down in order to balance out the equation. And how do I lower detection risk? I do more work, more substantive testing, bigger samples, stronger procedures. So let's check the choices. Choice A says decrease detection risk. Yes, that's exactly what I need to do. Choice B says decrease substantive testing. That's the opposite of what's required. Decreasing testing would increase detection risk. Wrong. Choice C says increase inherent risk. I can't do that. Inherent risk is baked into the client's environment. Wrong. Choice D says increase materiality levels. That would allow bigger misstatements to slide by, which goes in the wrong direction. Wrong. So the right answer is choice A, decrease detection risk. Exam trap warning. The bait here is choice B. Some candidates see decrease substantive testing and think, oh, less testing means lower risk. Nope. Less testing raises detection risk. More testing lowers detection risk. The examiners are checking if you remember the direction of that relationship. And here's your memory hook. Think of the audit risk model like a seesaw. If one side, control risk, goes up, the only way to keep balance is to push the other side, detection risk, down. And pushing detection risk down means I, the auditor, roll up my sleeves and do more work. Final answer, A, decrease detection risk. Here's the next question. Which of the following is an example of fraudulent financial reporting? An employee steals inventory, and the shrinkage is recorded in cost of goods sold. Company management changes inventory count tags and overstates ending inventory while understating cost of goods sold. Choice A says one only. Choice B says two only. Choice C says both one and two. Choice D says neither one nor two. Now the analysis, expanded with standards. Number 1, the employee stealing inventory. This falls under misappropriation of assets. According to AUC Section 240, consideration of fraud in a financial statement audit, fraud generally falls into two categories. Fraudulent financial reporting, intentional misstatements designed to deceive users. Misappropriation of assets, theft or embezzlement, usually by employees. In this case, the theft happened, but the shrinkage was recorded in cost of goods sold. So the financials still reflect the loss even though the crime occurred. That means the books aren't being manipulated to mislead. The crime is real, but it's not financial reporting fraud. Number 2, management manipulating the inventory count tags. This is exactly what AUC 240 is warning us about. Fraudulent financial reporting often involves overstating assets or revenues or understating expenses or liabilities to make the company look stronger than it is. By inflating ending inventory, management is directly reducing cost of goods sold and artificially boosting income. This is deliberate misstatement. It fits perfectly into the fraudulent financial reporting category. So the correct answer is choice B, two only. Now let's zoom out for exam context. Under the AICPA's AUC 240 and PCAOB AS 2401, the auditor has a specific responsibility to assess the risk of material misstatement due to fraud. The standards emphasize, fraudulent financial reporting is usually perpetrated by management because they can override controls. Misappropriation of assets is usually done by employees, and amounts may or may not be material. The auditor must maintain professional skepticism at all times, regardless of past experience with management's honesty. Also, per AUC 240, common fraud schemes include fictitious revenues, improper asset valuations, like inflated inventory, concealed liabilities, improper disclosures. This inventory tag manipulation is basically improper asset valuation, a classic fraud scheme. Exam tips. If you see employee stealing, think misappropriation of assets. If you see management manipulating numbers, think fraudulent financial reporting. Watch for wording traps where they mix one example of each type, then ask you to choose. The correct move is to separate the two categories in your head. Remember the auditor's duty. We're not expected to catch every fraud, but we are required to design procedures to detect material misstatements due to fraud or error. The emphasis is on material and financial statements. Memory hook. Think of fraud like two flavors of ice cream. Misappropriation is the petty theft scoop. An employee sneaks a carton of inventory out the back door. Fraudulent reporting is the numbers game scoop. Management rewrites the recipe so it looks like there's more ice cream than there really is. One is stealing stuff, the other is lying on paper. Final answer, B, 2 only. Next question. If a company incorrectly applies an accounting principle to a significant transaction and the misstatement was other than intentional, which of the following could describe the misstatement? 1. Error. 2. Fraud. Choice A says 1 only. Choice B says 2 only. Choice C says both 1 and 2. Choice D says neither 1 nor 2. Now, let's think this through. The key phrase here is other than intentional. That means the company didn't deliberately misapply the principle. They got it wrong, but they weren't trying to trick anyone. According to AUC Section 200, Overall Objectives of the Independent Auditor, and AUC 240, Consideration of Fraud, there are 2 buckets for misstatements: errors, unintentional mistakes, examples mathematical slip-ups, oversight, or misunderstanding of GAAP; fraud, intentional misstatements, including deliberate misapplication of accounting principles. So in this case, since it was not intentional, that rules out fraud. It's an error. Therefore, number 1, error, is correct. Number 2, fraud, is not correct. That makes the right answer choice A, 1 only. Exam tip: watch out for the exam's trick with the word misstatement. Both fraud and error cause misstatements. The only difference is intent. If the stem says unintentional or other than intentional, the answer is error. If the stem says deliberate, intentional, or management override, the answer is fraud. Memory hook: think of it like driving. If I miss a turn because I didn't see the sign, that's an error. If I miss the turn on purpose because I don't want to pay the toll, that's fraud. One is an accident, the other is a scheme. Final answer, A, 1 only. Here's the next question. Which of the following should be viewed by the auditor as a fraud risk factor? 1. Company officials have issued a report stating that they expect earnings per share to double in the current year. 2. There have been no missing documents and no delays in delivering the documents. Choice A says 1 only. Choice B says 2 only. Choice C says both 1 and 2. Choice D says neither 1 nor 2. Breaking it down. Number 1. Management promises EPS will double. This is straight out of AUC Section 240, Consideration of Fraud in a Financial Statement Audit, and PCAOB AS 2401 for public companies. Both standards define fraud risk factors in terms of the fraud triangle: incentives/pressures, strong motivations to commit fraud; opportunities, weak controls or complex transactions that create openings; attitude/rationalizations, culture that excuses or tolerates dishonesty. When management goes public and declares earnings per share will double, that sets a massive pressure risk factor. Investors, analysts, employees, everyone is watching. If real results don't match the promise, management may feel cornered and turn to aggressive accounting or outright misstatement. This type of target setting is a textbook fraud risk factor under AUC 2040.A1. Number 2, no missing documents and no delays. This is not a fraud risk factor. In fact, it's the opposite. It suggests good record keeping and cooperation. If the question had said frequent missing documents or unusual delays in providing evidence, that would be a red flag. But as written, number 2 is just normal. So the correct answer is choice A, 1 only. Incidental but relevant standards. AUC 315, Identifying and Assessing the Risks of Material Misstatement, tells us the auditor must identify risks by looking at pressures like earnings targets, especially ones communicated externally. That matches exactly what's happening here. PCAOB AS2401.07 specifically lists unrealistic earnings forecasts as a fraud risk factor. Exam tips. Watch for the fraud triangle. Any mention of pressure, earnings goals, bonus thresholds, stock price promises, opportunity, weak controls, related party transactions, or rationalization, culture of everyone does it, is a fraud risk factor. Don't overthink normal conditions. The exam loves to slip in something that sounds good, like documents are always provided promptly, to see if you'll mistakenly flag it as risk. It's not. Fraud risk factors are negative, not positive. Management versus employees. Big picture pressures, like EPS goals, usually point to management-driven fraud, fraudulent financial reporting. Missing inventory or theft scenarios usually point to employee fraud, misappropriation of assets. Memory hook. Think of it like a gym ad. If the trainer shouts, "Everyone will double their muscle mass this year," that's pressure and a red flag. If all the gym equipment is neatly in place and ready to use, no missing documents, that's not a red flag. That's normal. Final answer. A. One only.